All right guys, strategy development then. What we're going to look at is strategy development in three parts. We're going to look at how do you generate an idea, how do you generate a strategy, and what exactly goes into a strategy. So the sort of development and constant improvement of a strategy. We're also going to look at another part of learning from losses, learning from trades where you made mistakes, and how you can flip a losing trade into a winning trade. This is often the place where you learn a lot. This is often the place where many new ideas come from. And also the place where people don't want to learn, because at the end of the day, recounting how you lost money, recounting the mistakes you made is not an enjoyable experience and not something people want to do, but it's so valuable. Often you're going to get more from understanding what went wrong and how to improve it or change it than you are from looking at something that is already going well and trying to improve it. Improvement is harder than change, because once you've ticked off the easy improvements, it's hard to then find greater and greater improvement, whereas change is much more dramatic and can produce results much quicker. We'll talk about this as we go through in terms of skill gap as well. And finally, what we'll look at is more broad strategy. So understanding the concept of pattern matching, of seeing different patterns through different ways of doing this, be them event-based type patterns, and we've covered some of these things in terms of things like option expiries, government bond auctions, month end, stuff like that, but then also in sequence of action as well. So that's the three parts that we're going to cover. We're going to start off with strategy development in the kind of the rawest form, but go a little bit deeper into this. I think this is an area where people don't go deep. What they do is they go, right, here's a strategy, you do this, you get this, or you do this, you enter here, you put your stop here, you put your target here, and you get result. We know that doesn't work. We've discussed this for a few weeks now, and these types of basic strategies don't work. So you have to have a deeper understanding of this. So let's get into how you develop that deeper understanding, what goes into that deeper understanding, and how you can then constantly improve a strategy, constantly learn new strategies. Remember, the important part of trading is to learn and adapt new strategies. If you rely on something that's old, the only way that you're ever going to improve on a strategy that you just rely on the same thing, the only way is to increase size. But that strategy is not always going to work, so you have to understand when it works, because actually the way that you improve a singular strategy is understanding when it is best used, and that way you're increasing size at the most appropriate time, not just increasing it in line with an arbitrary measure, i.e. the size of your trading account. So let's get on to this. What goes into strategy development? There's a fair few different aspects, and to really summarize it, and then we're going to go into a little bit more detail of these different things. It's more than just simply a recognizable setup. That's where people make a mistake. It's not just simply, right, I have a strategy to trade a head and shoulders pattern. There's more to it than that. You need to understand in depth when you should trade this, how you can improve on this trade, where does the trade become asymmetrical, how can you most extract out of this type of trade. So we're going to go and start by looking at ideas. Ideas come from all sorts of places. Don't dismiss any idea that you have. Explore it. Ask yourself, could this become a trade? Is this actually something that is tradable, or is this merely somebody spouting an idea and that is all it is? So these come from seeing patterns that you've never seen before. You don't have to categorize every pattern according to textbook. As long as it makes sense to you and you know what that pattern looks like, how you describe it, that's all that matters. Because you can take that and you can turn that into a trade. You can think about positioning. This is where some of my favorite trades come from. The idea of understanding, or at least developing a sense of how people are positioned. You're never going to know precisely, and that's not your job. Your job is to assume positioning based on action. And once you can do that, you can also assume how that positioning would wind up. Simply because you have that experience. You know how you might get yourself positioned, and so therefore you know exactly the reasons that you might get out of a trade. It is fair to assume that you're not the only person looking at that trade in a very similar way. So positioning helps come up with ideas. Discussing it with people, taking losses. These are the things that are less chart-based, but go and talk to somebody else. Yeah, this is the point of a Discord group, of a community. Ask others what they do, how they play certain types of moves, why they are looking to buy in certain situations, why they're looking to sell in certain situations, and then take that and make it your own. You can never ever copy somebody else's trade or somebody else's strategy. Quite simply because you don't know exactly what it is that they see. They can describe it and they can be the best person at that. But you have to make this your own. You have to be able to see that situation in your own eyes, and you have to know how you would take that trade on. It could end up being that both of you take ultimately the same trade, but you might have slightly different criteria for entry, slightly different criteria for exit. That's the bit of taking ownership of a trade. And like I said, we'll come on to losses. The other aspect of a trade is the criteria of a trade, breaking it down, and we'll talk about this. And what I think is really worth doing, and I'll explain this in a minute, is to actually be able to draw your trade. Put yourself in somebody else's shoes and ask yourself, could you give them a description of your trade and they would know exactly what to do in a certain situation? They could identify that trade. They could work out where they enter the trade, where they expect the move to go to, where they can place a stop, how they expect the move to happen. That's what you need to be able to do. So the criteria aspect needs to be robust. You need to be clear exactly what you're doing, because otherwise you fall into traps, which we'll talk about in psychology, of seeing what you want to see, not seeing what it actually is, particularly when you learn a new trade. So we'll get onto that. Drawing your trades out. The other important thing, when's it used? Not every trade is applicable every day. Like I say, just because it's a recognizable setup does not mean it's the appropriate thing. Think about golf clubs. Just because you can use a driver does not mean it's the appropriate club to use if you're in a bunker. Apologies if you don't know much about golf, but you know what I mean. So when is it actually useful? You also need a trigger point. This is your final check on the trade. And it's not a trigger point trade, as we talked about in price action week, in order flow week. It is what exactly is the moment that you take the trade on. And every trade strategy will have that. There will be that bit of information that you need. So what's the pertinent information? What's that thing that you need to see to get you in the trade? Because if you don't see it, this isn't the trade. It is a nice idea. It might go where you think it's going to go, but unless it gives you that trigger, that little moment that goes, there it is, do it now, you don't have it. And that doesn't always have to be order flow. It may have to be a specific type of movement. It may have to be a specific pattern. It doesn't necessarily have to be order flow. Execution then. We'll talk about how you can gain edge from where exactly you execute your trade. And we've already covered this briefly anyway, so I'll just remind you of this. But you need to understand what happens when you execute. Where is your edge gained in your execution? Is your edge in the execution? Or is it indeed in a very specific trigger to the trade from a technical perspective? And the other thing as well is within that execution, the management. How do you manage that trade? How do you stay in that trade? What do you expect to see? I often talk to people about this type of thing where they say, oh, well, I got in and the market kind of stalled and it pulled back and I didn't know what to do. That needs to become part of the criteria. And if you don't understand it, then in future, that's an area to improve. And finally, is then synergy or asymmetry. When can a trade be sized up? When does the trade become asymmetrical? And also from a synergy perspective, can this strategy be kind of bolted onto another pattern, another structure? So that's the other aspect of this. Crucially, what you need to be trying to get to and where your biggest gains are going to come from. Once these are robust, the way that you're going to be improving a trade is by scaling it up. That's the bit that you're trying to get to. You don't need to worry about scaling trades up early on, because typically early on you gain so much from these aspects that the scaling up or the improvement in performance comes without even having to scale up. It's only then where you can understand even more deeply when this trade really has value that you can now start to scale the size up and get the advantages there as well. So we covered the brief bits of it. If you're going to take away one kind of phrase or explanation of this, you've got to learn the skill, not the drill. You're not trying to learn how to spot something, how to execute a specific thing. You've got to learn the skill of the trade. You've got to learn slight variations within a trade. You've got to be robust in what characterizes it and what identifies the trade, but you need also to learn the skill that is required to actually execute that, to get that trade done, to get the move that you're actually looking for. Right then, building a strategy. And there's a few different aspects that come into this. We've summarized them on the right. But one of the first things that you're going to be able to do in terms of developing new strategies is gaining information. Now, if you're debriefing, as we talked about in week 5, if you're doing your debriefs, if you're then reviewing your debriefs, this is what gains information for you. And we'll talk about different ways you gain information that you're already doing, and just to kind of bring that home. If you are doing consistent debriefs, you're building up an inventory of information anyway. What you've then got is the ability to objectively go back through those, pick specific aspects of them, pick specific trades, and then look more and more at the details. Where did the order flow change? What's the catalyst for the movement? Do these trades happen to appear on certain day types? I'll be talking when we get into the pattern matching aspect about how do you structure this kind of analysis, and how do you make this easy to then identify certain patterns, certain types of criteria. The next up is pattern matching. And this is going to come from various different aspects. And that's the thing that really you need to keep in the back of your mind throughout this section. That pattern matching is about not just recognizing wide patterns, but also recognizing very specific things. I've worked with someone recently who was looking at inside days. And so rather than looking at the basics of it's an inside day, this is how you play it, we went more into detail about specific things that were common to each inside day, which suddenly identified new trades that were still within the day without even seeing the breakout. And that's really valuable, because all of a sudden now what you're doing is you're taking something and you're investigating it further. You're finding other trades within a more generalized trade. So you have the wider pattern that will identify specific types of days, specific types of movement. Then you can take all of those and you can break those down into what is common about each of them. What are the key aspects of those? Reviewing trades is so valuable. Because reviewing trades can improve current trades, it can develop new ideas completely, which we'll see in turning losers into winners. Reviewing other people's trades. Yeah, there's a lot of value to be taken by collaboration here. Somebody explains their trade to you, you explain their trade to them, or you explain your trade to them, and you both then review those trades from your own perspective. All of a sudden, you may well see something new in your own trading, or you help somebody else see something new in their trading. So not just a personal pursuit this, but review trades as a group or as a pair, as a collective. That's got a lot of value. But when it comes down to reviewing, your objective of reviewing trades is to look back over them, to be creative. It's not to look back over and be critical and say, oh, I could have done that better, I should have done this, I should have done that, I should have done that. Ask yourself, how else could this be traded? What were the key aspects of this trade? How else would you approach this? Could you approach this in a completely different way? Is the optimal choice actually to be buying instead of selling? That whilst you may be selling for a quick break, let's say, there's actually a lot of distinct criteria in that identifies perhaps a false break. And so actually, your sell for the quick break is actually a better trade to sell and then reverse it, for example. And then finally, this is the bit that turns it into action. Because all of these things are great. They create ideas, they create information. Ideas are only useful if you turn them into action. And so what you then need to do is condense your trade down. This is something that I took a lot from the book called The Art of Learning by Josh Waitzkin. He talks about condensing down actions into a few very key moments or points that once you see this and this and this, you act. And it becomes intuitive. And this is where people seem to know things before they know them. They don't. But what they've done is they've condensed the information down by understanding that information deeply so that they see something and there's almost an automatic response to that. So what you try to do, you try to shorten your process of execution. You create a trigger that leads to an expected trade. There is a certain characteristic, and as soon as you've seen that characteristic, that entry point, that certain type of candle, whatever it is, you've got that and you can immediately act upon it. That shortens the time to identify and act, which improves your edge. What it also does is it limits hesitation. Because if this becomes intuitive, you internalize it, then the hesitation goes because you almost just act before you get the chance to hesitate. You know what you're going to do, you see it and you do it. And that's the way to try and think about it. Right then, how do you gain experience? There's a few ways that we've already talked about that you can do this. First up, your daily hypotheses. Don't underestimate the value of these. Because what a daily hypothesis can do is it forces you to consider options. Now, if you have these options set out, irrespective of what happens on the day, what you've done is you've given yourself the ability to now see things in a different way. You've given yourself the ability to have prophesized or at least thought about how a market might work in one way or another. But what it also does is it gives you something to compare back to. So it gives you a basis for testing. If you can test, all of a sudden you can see some degree of consistency in what does work on certain days. You may start seeing that for every liquidation day, there are certain trades that you spotted and you traded. And all of a sudden now, when you have a situation that looks like it might be a liquidation day, you've now got much more robust criteria in what you can do. Just comparing hypotheses of certain types of days, again, is going to help you develop new trade ideas. That's where the caught in the hole trade comes from just seeing certain days where you've looked at the previous day, you've seen a complete lack of value on a move, and you start seeing a consistency that, having hypothesized what can happen the next day, there seems to be quite a regularity in the reversal move. All of a sudden, you can now start saying, well, how do I turn this into a trade? How do I develop a strategy around that idea? Trade monitoring. You should be doing this anyway. If you monitor your trades, you've got a much more robust way of defining a trade when you're about to take it, which reduces all of the hesitation side and makes it clear what exactly your purpose is on a day or within any kind of trade. It reduces hesitation, it creates accountability. We've discussed all this, and this is so valuable. So monitor your trades, but what it helps you do, importantly, is trade monitoring gives you result monitoring, because the result side of things is where you can develop new strategies. You may well have a trade that is to buy at a certain point and you're looking for a move back into the middle of range, but if suddenly you're seeing that the result of this, the post-exit move, is consistent, again, you can then find all of the similar trades like that, and now you've got a new idea. Now you can see how actually this turns into a continuation trade, or this turns into another trade. So result monitoring is so valuable, but don't dismiss result monitoring when trades lose. Because if a trade loses, again, if you're seeing a similar result each time the trade loses, then suddenly that's pointing you straight in a direction towards a new trade idea. Everything you do, one of the key things to try and keep in your mind is, can this be self-coaching? Does this lead me to a new idea? And if it does, wonderful. That's what you want to be using it for. So, with the daily hypotheses then, what you're trying to do is you can then take your hypothesis. At the end of the day, it's very easy to then look at your hypothesis and look at the result. So, you're testing your hypothesis. You're testing how good you are at identifying certain situations, how well your hypothesis compared to the actual result of the day. This will then start to lead to you being able to recognize certain types of day, to be able to more quickly identify certain types of day. And from that, you can then say, right, on this type of day, I have certain types of opportunities. Where this is so valuable is this now means that you have linkage. And what I mean by linkage is that you can develop a strategy because you look at a certain result, you see a certain day type, and this provides you with certain types of opportunities. List your opportunities out on the day. Where could you have taken trades within this day? Now all of a sudden, you're not just looking at a specific pattern or a specific strategy. You're able to link this to a type of day. You're able to link this to a sequence of days that results in a certain type of day. So all of a sudden now, you not only have a strategy, but you have an expectation of when this is going to be useful. It's not about getting to the moment and saying, this might be useful. It's about being able to say, I think this strategy is going to be used today. You're ready to use it. Again, shortens and condenses that process of what strategy to use, what should I do here. You're already thinking a step ahead that I think this is maybe well be useful. You've seen days generate like this. You've seen certain hypotheses result in certain actions, certain types of day, and you know the opportunities that are available. The other way that it helps you is going back to a day type. You can now start to look at it from the point of view of where is your performance. If you see, and this is where using your P&L can be helpful, get your P&L up and look, is there a certain type of day that you consistently perform well? And if there is, this answers a question in one of two ways. Is it that you take certain types of trades on those types of days and they perform well? Or is it that you take the same trades over and over, the same strategies over and over, and now all of a sudden you've been shown very clearly by your performance that they work much better on certain types of day? If you're somebody who likes reversal patterns, then chances are you want to be looking for a much more balanced type day than somebody who likes a breakout type pattern. So it allows very easy comparison because you're not now comparing performance day after day after day, going, oh, well, that was a good day, that was a bad day, that was a good day, that was a bad day. You're comparing in context of the type of day. And if you can say that you are consistently a good performer on balanced days, all of a sudden now you're able to start looking for balanced days, or you're able to identify that you have the strategies for a balanced day. Now you can move on and develop strategies for non-balanced days because you can see when the strategies you have don't work. Use that to identify new strategies. And use the balanced day strategies to now be the ones that you can increase, that you can improve, you can up your size on. The other aspect of having a hypothesis and seeing how these play out is that you've got a much better understanding of how trades play out. Such a common thing, and I've probably mentioned this numerous times, that what people have is expectations that look like this. Because when you develop strategies, and this is the basic level of a strategy, your strategy may say buy the level when you see X, Y, Z. Great, you've seen X, Y, Z, you buy the level. Target is up here. And if that's all you've got as a strategy, that you see this, you do this, it goes to target, what you've actually got is an entry point and nothing more. Because without an expectation of how it gets to target, the target is merely a point that you would like it to get to, and chances are you will not get the move there, simply because the way the market actually moves. If the reality is more like this, then what happens is that you won't hold on to this, because if this is your expectation, anything that goes against that becomes evidence that the trade is wrong, talks you out of the trade, and you end up giving the trade up. That's where profile and developing hypotheses of what can happen on the day, and then also how it happens. So looking at the result of these hypotheses, looking at where the opportunities were, helps you to understand much better, and this is a key criteria, much better how you deal with this reality. That's the thing that people struggle with most, the reality of the move once they're actually in. This again comes back to psychology, which we'll cover. It comes back to the psychology of averting loss. Anything that's not doing exactly this creates a sense that you might lose, and people don't want to lose. So anything minor pullback all of a sudden looks extremely bad, and you start thinking, I don't like this, I need to get out of this trade. Right, trade monitoring then. And use this as a way to do it. You can develop this in your own way, precisely how you want to do about it. But like I said, it is multi-purpose. It does, in the first instance, help you actually trade. And this is something, so many traders use this, no matter what level of seniority they are, no matter how many years they've been trading, because it combats the temptation to get out of trades or the doubt. It solidifies ideas for you. This is really valuable. So break it down like this. Your product, just so you know which markets you've been trading. What's the context? So what is the sort of situation on the day? This doesn't have to be massively detailed. What it needs to be, ideally though, is consistent. So if your context is balanced morning pre-data, that needs to be a consistent thing. That would be something that you're likely going to write on the morning of payrolls, the morning of CPI, the morning of a central bank, something along those lines. Where's your entry? What's the reason for the entry? So this is the trigger. What is the bit that gets you into the trade? The context is generally what's going on. The reason is the specific strategy used. The stop, the target, exit. Where did you get out of this trade? Was it at stop? Was it at target? Was it somewhere in between? Because any of those gives you an area where you can then look at the result. Because if you're getting exit at stop consistently on a certain type of trade, quite possibly, particularly when you look at the result, either this is a good stop and you're executing that well, or if the result is consistently that it then goes to target, are you actually misplacing your stop? So it helps you identify very easily what aspect of the trade is the bit that needs changing or is the bit that can be improved upon. What it also helps you do is categorize trades into a playbook. What you can do here is you can color code it for similar trades, which again then makes your life easy. You get this at the end of the day. If you've done this on an Excel spreadsheet, at the end of the day you go, right, that was a breakout trade, that was a reversal trade, that's a continuation trade, highlight, 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 highlight. And then you could also then go and say, look at the results of each of these from a performance perspective to see which trades are working on which day. And that's the performance evaluation. Look at the result. What happens after the exit of the trade? And ask yourself, well, is that target ever reached? So the point here being, you're trying to identify the aspect of the trade that is the reason that this trade works, the aspect of the trade that is the reason that this doesn't work, and what bit of it can you change? So you could then go, right, well, if this was the result, is the target appropriate in relation to that? is the stop appropriate in relation to that? So you're taking your trade out of it and saying, right, well, if I entered here and we went here, now where is the appropriate place to put a stop on this trade? Where is the appropriate target on the trade? Rather than just saying, right, well, I got in, it went to target, therefore it is good. Look at it more deeply. You got in, it went to here, is the target good? Relative to the result of the trade, not relative to where you exited. And the basic terms of a trade being good quality, and the easy assessment of whether a trade is good quality to start with, is to say, you entered here, you had a target, you got out at your target or your stop, that is a good trade. Now, whether that trade made you money or lost you money is not relevant. It's about whether you planned it out and you got exactly what you wanted. Now, once you've got what you wanted, you can always see if you could have got more, if you could have improved that in some way. So the assessment of the good trade is, did you stick to the plan of the trade? The improvement of a good trade or a bad trade is to look at what happened next and then work out, could the plan actually have been improved? Doesn't make the plan on the trade taken bad. It makes the plan on the trade taken good. You executed it and you got what you wanted, but that can always be improved. And so this then helps you develop this playbook. Now, we've talked about this already, but this is essentially the foundation for any strategy. Because if you take one trade a day, or if you take a set of trades after you've started accumulating through trade monitoring, and then go and break those down, what you're looking for here is common criteria. You're looking to say, right, if this is what happens, what aspects of that are consistent throughout? What aspects of that are useful to see, but not necessarily completely imperative to the trade? What aspects of it do you not want to see? This leads to you being able to draw the trade out ultimately. And that's one of the things that we're going to get to in a little bit. And like I said, organize the trades. It's one thing to monitor them on a day-by-day basis. But unless you take time to organize them, and I would do this at the end of the week, otherwise it becomes onerous if you've got a month or a quarter's worth of trades. Do it at the end of the week. This way, what you can start to see is certain trades that you're improving on, areas where you can improve, areas where there are new trade ideas. And the other thing is create different playbooks for different events, for each data point. Treat these separately, because trading data is a strategy in itself. How do you do it? How do you go about trading data? Central bank results, anomalous news type data, or news type information days. So those days that you can't necessarily be able to foresee coming day after day in the sequence of technical analysis, the news-driven, event-driven, data-driven days need to be days that have their own playbook, so that you're then able to develop an idea around what do you do in this situation. It's about creating a process for the uncertain. And you can trade things that are completely uncertain, as long as you have a process that if you're in this situation, you're going to do this, or you're looking for this, you expect to see this type of movement. That's what you're after. So remember, that's going to form the foundation for most of your strategies, or going to be one of the places that you develop the majority of ideas from. So what goes into a strategy? Key elements of all strategy start from an idea. This is the bit that I think people get wrong. People invest too much time in. People overcomplicate, and unfortunately, whilst overcomplicating, often don't add enough complexity to an idea as they actually necessarily should. They go back testing this ad infinitum, hoping that something is going to pop out of this magical back testing. You've got to leverage what you're good at. And I'll talk about this in a minute. Because back testing, as an individual with a standard or even a reasonably high quality computer at home and a decent internet connection, is still not going to be anywhere near the scale of testing that a team of people at a hedge fund with £1 billion worth of investment into testing can do. So you're competing in a completely different playing field. So you don't need to. Humans have an innate ability elsewhere, and it doesn't have to be data driven. From your testing then, go and define the trade. This is putting the criteria together. Being clear on what the trade is, execute the trade. Once you've executed it, you can evaluate the trade. Again, we're going to look at the evaluation part of this as well, in terms of performance of trade. So the actual performance of a trade, is this worth doing? And also the less tangible kind of psychological aspect of the trade, and understanding where the psychological aspect of a trade working or not working really comes into play. So all those bits are coming up. We're going to start off, of course, with ideas. Where do you get these from? Now, ideas come from all over the place. The easiest one and the easiest thing to do is to reverse engineer something that's happened. Market moves in a certain way. Market breaks out. Market trades in a range. What happens in that? Reverse engineer that. What you're looking for is the ability to identify it as it happens. It's easy to go, oh look, it was a range-bound market, so what you do is you buy and you sell. That's easy in hindsight, of course it is. What tells you it's going to be a range-bound market? How do you identify this as being an opportunity to sell and this as being an opportunity to buy rather than an opportunity to play and continue to move down? What is it about that? So that's what you're trying to reverse engineer. You're trying to ask yourself, well, if I see this, what's the defining characteristic? What's the identifier of this? This is where hypotheses are very helpful, because what they do is they forward engineer something. They go, right, we've seen this. What do I think is going to happen next? And if you can do that, all of a sudden now you say, well, what I think is going to happen next, we're going to break here and we're going to trend up. All of a sudden, if that does trend up, now you've got a new strategy because you've effectively forward engineered a new idea. You've hypothesized this and you can say to yourself, right, well, I expected that could happen. It did happen. Next time I see a range-bound move, I can expect this again. So it's about then looking at the range-bound bit that identifies characteristics or identifies clues to the trend move. Speak to other people. Like I said, other people have different ways of doing things. Look at people on Twitter, but don't look at what they say as rote. They are not an absolute expert. They have not got some kind of magical formula, a golden goose, a special way of doing something, because if they did, they would be very much keeping that to themselves. There's no value in distributing that. And this is where people who have this is the strategy, repeat, or signals, don't work. They consistently don't work. You have to be able to develop this for yourself. But take what other people are saying. Take the way other people approach things as a way of developing ideas for yourself. Try and put yourself into their shoes. So particularly if you've got a group of you, if you've got another person that you trade with, try and understand how they would take a certain trade on. Because now what it allows you to do is see things from somebody else's perspective. You understand why other people might do something different to the way you would do it. And now this gives you the ability to develop a new idea around that situation. It might allow you to actually take a trade that you wouldn't typically take, because now you understand somebody else's reasoning behind it. You can apply their reasoning to your current view of that situation and use that to now understand how you could trade that situation, a situation that perhaps previously you would suggest or you'd be inclined not to take. One of the trades I'll use as an example in a minute is exactly that. A situation where I'd seen and thought, I hate these situations, give this one up, forget about this, and having spoke to somebody else, start to see their perspective of it and start to see, actually, well, this is the way they do it. How can I use the skills that I have, my approach to trading, to trade an idea that somebody else has, to trade somebody else's kind of structure and understanding of a situation that I currently don't like. And this also links to scenario building. What would happen if is such a great question, because to generate ideas, you can say, what would happen if this piece of news came out? What would happen if we got a trend followed by another trend? What would happen if, or what does happen when you break a significant daily level? Does the market collapse out the sky? Because the easy thought on there is massive daily level, break through it to the downside, market collapses. What actually happens? What's the reality of it? And so asking yourself questions like that, what would happen if this? Asking yourself, how's the market going to react to certain figures? This improves your ability to be creative, for one, but it also allows you to then start thinking about how you would act in certain situations, and this develops new ideas. You might suddenly think, oh yeah, that's how I would do it. That's what I'd be doing. I spoke to a senior trader recently before a Fed decision. I said, what do you think about this? What do you think the action could be, or what do you think the market results can be if they do this, this, this? And he said, I don't actually think about that too much. What I'm thinking about is how exactly is the market going to move? Irrespective of which way it goes, how is it going to move? What's it going to look like? Because that's going to define what you're going to do. It's very easy to scenario plan. If a central bank does this, market's going to do this, therefore I will buy. But how is the market actually going to move in that situation? What exactly is going to happen? Because that's the bit that you need to be able to decide. How exactly are you going to buy this? So it comes down to the execution aspect of it as much as the just general hypothesis bashing of, oh, they could do this, they could do this, they could do this. That's great. They're all the things that could happen. What's the market going to actually do if those things happen? And how do you trade it? Equally, don't dismiss textbook trades. There are reasons why there are textbooks of technical trades, that some of them work. What you've got to work out is go, right, well, that's a decent one. I like the look of it. I understand the concept behind it. It makes sense. Great. So it makes sense to you. When does it work? Does this trade actually make sense? Does this trade really work out? 5-minute shooting star candle, for example, can you trade them? Or more to the point, not can you trade them, because of course you can. You will see one and you could trade it. When should you trade it? That's the question you should be asking yourself. That's how your ideas start developing. That you can be looking for something, you get that candle, and now you can trade it. Quick look at an idea then. And this, as I said, is a trade that I don't like, or didn't like. The idea I liked, you've got a market opening here, you've got value left below. So from a profile perspective, that was a day that I looked at and thought, great, back down to value. If we can hold there, we are on a move higher, we potentially have got a move towards the upside. But equally, if we drop down to value and we start to build some volume down here, we've got the potential of sweep here, and start this move lower. Now that kind of leans towards my personal preference, if you will, to a more breakout style. But once you then speak to others and you start to identify and objectively review what exactly happened on the day, the different parts of the day, because this is somewhat of an odd looking day, I think is fair to say, that you've got balance followed by a very late kind of drive higher. It's not a double distribution, it's not really a trend day, and I wouldn't call it a liquidation day. It's a balance followed by a drive late on. So it's a rather anomalous day, and I don't think that's the thing that we're necessarily looking at. But what you can do is you can break down the aspects of this. Get a 5-minute chart up. Well, what happens down here? We get this steady move down back towards the VPOC, and then you get this block forms at the low. Now, from my perspective, that is an opportunity to look at and go, brilliant. We've got a block forming below 45, great. Got the chance to sell this, we're going to go through the lows. And frustration then creeps in as it doesn't. And instead, volume dies off. Delta starts to drift up, market sits sideways. So this effectively plays out as an inversion of my original idea. My original idea is, well, we've moved down, albeit steadily, now we're going to wash towards the downside. And so you can then start to ask yourself questions about, is the environment right? Is this a day where you should be expecting the fall? A lot of that comes from your order flow. If the order flow is not consistent with a market driving to the downside, i.e. it lacks energy, or the energy just disappears out of it, participation effectively just falls away, then if that's happening, what you can start to think about is how else could you play this? Asking yourself, well, once it came out of this block, what happened here? Why did this move happen? And so start off by just objectively stepping through the stages of, right, we've opened towards the high of yesterday. We trade in a, albeit rather choppy, down move. Before the market then runs out of volume, delta starts to increase and trades in a sideways block. After that, you then section out this bit, a steady grind back through the high of the day and continuation towards the upside. And what I put there, this was from one of my own debriefs. No opportunity to pyramid. Have to take the break and hold on. Did one time frame on a 15-minute for the whole move, you can trail a stop. That was kind of an observation that I made of this trade. That you could look at this and say to them, okay, right, well, just on the first instance of looking at it, okay, well, if I buy this, I've just got to get in and stay in. Now that's not massively detailed, but that gives you the chance to then become a bit more creative with that idea. So once you've developed an idea, you can go and test it. Remember, with testing something, you've often done this. You've often done most of the testing because you've identified these trades in the past. Why are you taking the trade on if you hadn't already identified it? So you've been monitoring, you've been tracking the results of the trades. One way that you can backtest something is to go back through charts and look for it. Now what I would do here, it's a really easy way to do it, is you get your chart, scroll back to a specific date and roll forward. Where people make mistakes when they go and test something is they roll their chart backwards. And what they end up doing is looking for the move that is the result of the action they want. So they see the move and then they see the identification of the move. Take, for example, let's say a 5-minute shooting star. 5-minute shooting star. Now, if you roll back through your charts, what you do is you see a down move like that and you go, right, I'm coming this way, let's go and have a look at the top. 5-minute shooting star, tick, that one works, good. Whereas if you go forward through your charts, you see this differently. Because now you see a market that trades up, 5-minute shooting star. You're now getting better at pattern recognition immediately because now you've gone, right, there's your shooting star on the back of a move up, market should trade down. Great. Does it? Because for every shooting star like this, there's a lot that will put a shooting star in and the move will continue. But if you've got the ability to recognize the pattern and then say to yourself, right, this is what should happen, very quickly, you get shown whether it does and what it looks like when it does compared to when it doesn't. You're identifying every instance rather than just simply the instances where it worked, which gives you confirmation bias, gives you availability bias. And the other way to test it is run it back for a ladder, replay it if you record your screens as well. This is the bit of testing the specifics of getting into the trade. The when do you get in, the how exactly do you execute the trade. Also, watch the trade move to target so that you can experience that, you can visualize how exactly it does it, rather than, again, seeing the job as done as soon as you enter. You go, click, I'm in, the job is now done. You can't do that. You've got to run it through, and so re-watch it. How does it move to target? This will help improve your recognition of order flow at specific points where you need to get in, understand the order flow as the move happens, and it also allows you to visualize the trade. There's so much value in being able to visualize the trade because you can visualize what it looks like. This condenses your identification of the trade. It speeds up your ability to go, right, there it is, buy it, because you've seen those bits of order flow already. You see it happen, you execute. But what it also does is it allows you to visualize doing this with more size. It allows you to also visualize the entirety of the move. So you experience the whole move kind of in your head. You know what this should look like now. Now you can take it on much, much more confidently, much more clearly, with much more conviction, and as a result, more size. Now, there's an element to testing which I think people fall into a trap. There's two ways to test things. You have a data way of testing things, or you have a narrative way of testing things. Now, when I talk narrative, what I don't mean here is a news story narrative, or a inflation story narrative, or a central bank narrative, or anything like that. I mean humans' ability to see things in narrative, rather than the traditional testing, which is entirely data-driven. Now, I'm not suggesting data-driven testing is bad, but data-driven testing in something that is completely dynamic and to a degree subjective, i.e. trading, does have its limitations. What this all comes down to is understanding what goes into intelligence. Humans have intelligence, computers don't. So the idea of backtesting this with a computer misses a key aspect. Because what you have is you have data. Data gives you reference points. So when you have a specific setup, you can plug certain pieces of data, certain reference points into a back test. That's the data that goes in. But what we can take, what humans can take, is information. Data within context. Does this happen at certain times of day? Does this happen on certain events? So it's not just simply the data of the setup, but it's also the contextual information there. So that you're not just seeing every instance of something, you're seeing or you're able to view something from the perspective, I'm looking at every instance that this happens in this context. And context is a hard thing to define from a purely data perspective. What you can then do, and this is where you don't necessarily need to backtest in quite the same way. Because humans have intelligence, we can make predictions from information without a great deal of information as well. Humans think in narrative. So we think in terms of, I see something, I can make a prediction about what would happen if I see that again. And if you see that again, now you can be confident that your original prediction was right. So you only need 2 data points to be able to develop at least the beginnings of a strategy. Whereas with data, the way that data works is what you're trying to do is you're looking for the probability of something happening as a result of certain amounts of data. The more data you plug into any system, the greater the smoothing effect of that. So effectively what you manage to do is come up with more consistent average results. And the point here being consistent average results. It doesn't take away the ones that don't work, it just says on average this is likely to work. But it doesn't give you any context, and it doesn't illustrate, and particularly this is one of the big dangers with often backtesting, is what people do is they don't put in the criteria. There's a conditional element to this. That what people may well test is, if I see this pattern and I buy, does the market go up? Great. And you may well find that there is a consistency that it does, maybe 80% of the time. But what needs to be conditional there is also the aspect of, does it go up without going to a certain point on the way. So if, let's say, the idea is you buy here and the market goes up, great. But does the market go straight up, or does it go like that? So you need to also factor in the aspect of the conditional element of it needs to go to here without going to here. So it's the probability of this without this, or conditional upon that. The other thing is, as well with data, is that what data does is it's always trading a previous example. The proof of the trade's probability or likelihood of working relates to the amount of data you fed in and the ability to say, right, well, if I've got all of this data, it suggests that this works. But that's always looking at what used to happen. When an environment changes, when a situation changes, that previous data isn't necessarily relevant. And so whilst plugging loads of data in seems like the best way to backtest things are dynamic and things change. I often see this and it frustrates me when I watch sports and they say, well, this team hasn't beaten this team for the previous 30 years. Now, that's not relevant to the likelihood of them winning the next game, because what contributes to them not winning for the last 30 years is a variety of things. And the players that were playing 30 years ago that contributed to that data are absolutely not playing now. So the data immediately is irrelevant or becoming irrelevant. And this is similar in trading. That if you can say, oh, well, we haven't done this for so many years or over the last 20 years, but what's been happening over the last 20 years? That's the bit that that needs to be sort of thought about more with backtesting or simply backtesting things. Whereas from a human perspective, and this is important, that what you're doing with data is you're backtesting probability. Is this likely to happen? If done consistently, is this likely to happen? What humans can do is they can look at things from the perspective of forward testing, the propensity to be something. This way, you only need a small bit of information to be able to assess certain likelihoods of something. So you're working on propensities. So you see a new pattern, you can make a prediction. As soon as that prediction plays out the next time, so you see something, that reversal trade, you go, right, well, next time I think this could happen. If that does happen, you've now got confirmation of it. Now with confirmation, you can be more confident to take this strategy on again. You now have a new strategy. And that's because what you're looking at is not the probability based on previous examples. You're looking at the propensity of it being something based on the information you have at hand. I use an example of when kids learn about different animals. They may see something and you identify a bird to them and they call it a duck because the first bird they saw was a duck. So what they're going on the basis of is all birds are ducks. Now what you can start to do is identify different things. If you see a bird with webbed feet, this has the propensity to be a duck. So it is no longer just a bird, and it is not definitely a duck. But it has the propensity to be a duck more so than it is any other bird, or it's a certain category. And then if it quacks, the propensity is very much that this is a duck. You don't have to have seen it, you don't need evidence, you don't need to have seen a million different ducks to be able to say this is what a duck is. There are certain characteristics of a duck that suggest if you see webbed feet and a quack, and hear a quack, propensity is this is a duck. Now, you could get this wrong. Could be another bird that's mimicked a duck. But the chances are quite low of that, and the propensity on the information you have is it's a duck. And that's what humans can do. A computer can't do that from seeing one image of a duck, an image of a sparrow, an image of an eagle, and hearing a squawk, be able to identify if you see one thing about the duck, it is likely to be a duck. Because the computer needs more information, more data to say on average this is going to be a duck. Right then, so let's break down some criteria. We've seen this trade before, now you see another example. What you're asking yourself about then is, now that you've seen the basics of the movement, what precedes it? Because the bit that we were interested in is this bit. Because that was the bit, and this is where the trade idea came from me, because that was the bit that I was not looking for. And now I can see it, because I spoke to somebody else who described their way of viewing this. My view was, market's going down, consolidation, continuation, breakout. Somebody else sees this in a different way. I didn't see this. Of course I saw it, but I didn't see this as an opportunity. So what precedes it? And this is where you've got to be looking at the type of move, the volume within the move. What happens to the order flow within the move? So you're asking yourself questions about, is there a certain distance that you have to move from an entry point? Is there an expectation that you're looking for? What then triggers the entry of the trade? What is it about this that triggers this move? Is it just the sideways action? Is it the delta? Is it the volume? What is it? So what you're trying to do here in terms of criteria is break down what is going to say to you in future that the next time you see this, because we've now seen two of them, next time you see this, what's going to tell you to buy? Because just seeing a sideways acting market is not an indication to buy, it's an indication that this is a sideways market and it is not doing anything. So what is it that tells you to buy? The other thing that you have to ask yourself as well is, once you've defined your idea of where you're going to buy or how you're going to enter the trade, does the trade develop in a certain way? Does this suit your style? And this is then your ability to differentiate from somebody else's trade. Somebody else will trade this in a certain way, you will trade it in a different way. And what you've then got to look at is, how do you execute this in accordance with the skill set that you have in a way that is going to suit your style of entry, your way of taking the trade on? Also ask yourself, is the stop prohibitive? And what we're going to look at in a moment is risk reward of the trade over time. So this is then a way of working out essentially the value of the trade over time rather than the value of the trade in an individual basis. And finally, you then need to be looking at the trade from the perspective of it giving you multiple entries. Can you scale this trade up? Can you improve this trade? Can you add more size to this trade? And how would you go about doing this? On the point of a stop, it's always easy to take a trade on. You find an entry and you buy it. But is the stop prohibitive on the trade? Where do you set the stop? Because if you're finding this is a stop that is too far, that you can't cope with that loss, whether it's the right stop or not. So let's say if you buy the break of the block and you put your stop down here, if that's a stop that for you is too big, is an amount of money that you're not willing to accept, is this a trade you can really take on? And you have to ask yourself these questions. Because if it's not, then you can dismiss it. But more to the point, I would be judging the stop on, does this offer enough to justify a stop down here? And if it does, you can take the trade on. You can always lessen your stop by reducing the size. And particularly then, if you're looking at how else you could enter the trade, you can get more size in later on anyway without the bigger outlay at the beginning. So again, this comes down to your style, to understanding the nature of the move and therefore being able to adapt your way of taking the trade on in relation to the way you trade. Right then, the trigger point and the execution of a trade then. So what we're looking for here is to break down the context of what can happen. How exactly are you going to enter the trade? Where's your stop going to be? What's your target looking like? So in this situation, you've identified the breakdown, you've identified the sideways block, and this is another example, a slight variation. And what you get is you're identifying different points to get you in. The first way that I've looked at this trade is you get an impulse. This is people buying on the break. This is something that suits my style. This is something that I like the look of from an order flow perspective. Great. So you get this impulse move, which pops us out of the range. This comes on the back of a move that has struggled lower. You get a more stagnated auction. You get delta rising. All of these things factor in. So now that you're seeing this, you can now look for your entry. And once you get this impulse move, that's then the point where people who've been selling it down here, looking for a continuation that they have not got, start getting pushed out. So that's the first liquidation. This is some people just giving up on the trade. After that then, you get another opportunity. You get this passive entry. What happens is where you've got this little sideways block, the market breaks away, people who are short in here get forced out, and then we come back. When you come back, that's an alternative way of entering. So this becomes a passive entry, this becomes your impulse, breakout, aggressive entry. But once you're in, then you've got to think about what happens. How does this move actually play out? And the other thing you need to know is exactly where your stop is before you enter the trade. If you're going to take this trade on, what you do not want is it to break like this, come straight back in, and now you're sitting there scratching your head, not knowing whether you should be out or you should still be in the trade. Asking yourself where the stop is, because in that situation what happens is you don't answer where the stop is, you answer how much money am I willing to lose here, which is probably not a great deal because everybody is loss averse, they don't want to lose money, and very quickly you go, stop there. And that's got nothing to do with whether this is a sensibly placed stop. because there's been no plan into that. All that you've done there is you have acted or reacted to the position you have and the possibility you might lose money, and put a tight stop to try and alleviate that risk. You've got to think about the types of trades. For me, the way I approach this is if this falls back inside the block on the first entry, that's an impulse move. That should create liquidation and movement away. If it goes out and comes straight back in, that's not the trade I'm looking for. So that trade's over. But when it comes back, I put the stop below the block. The reason being, this can come back, trade in, and trade back out. There are still buyers down here. That's why we didn't go lower. So if we come back in, some of those buyers are going to see this as an opportunity to scale across this area. So if I'm buying the second pullback, I'm looking for a stop down here. If I'm buying the first breakout, it needs to happen immediately. And then beyond that, your target. And not just your target, but how do we get to it? And so I break this into, first up, having a fixed target. If you have a very fixed target, put your order there already, you get yourself to the front of the queue, you're out of the trade when we get there. But also think about targets in terms of this being a point where you can make a decision. And then beyond that, a non-fixed target. If you have a non-fixed target, a runner, what's the criteria to exit? That's crucial, because you need to have some distinct criteria that's going to get you out of that. Be that a moving average. Whatever it is, there has to be a reason to get out. Otherwise, you will run indefinitely that trade, and who knows where it's going to end up. Quite possibly, you will be influenced by it rolling back towards you, and you go, oh no, I don't want to take a loss, better get out here. So make sure you're very clear when you're developing an idea of your execution of the trade, where your target is. And one thing I would say on target, going to the point of how exactly do you take the trade on? Your target needs to be a reference, not a number of ticks, not a specific point. On the day when you take the trade, you can say that is X number of ticks, that is that price. But the trade as a whole has to have a target that is a distinct reference point that is consistent. Take, for example, something like this. Your target is the high of the day. If the expectation is we grind through the range, then your target is the high of the day. There's always going to be a high of the day. If you're playing a block reverse from the low, for that to be the low, there must be a high. That's your target. So it has to be a consistent reference point. So you plan the trade out onto the evaluation part. And there's two ways to evaluate a trade. There's one aspect, which is to consider the performance of the trade. So this is where you can statistically look at how the trade performed and also assess how you performed according to what you planned, what could have come of the trade. This way you get to understand, so effectively what you're leaving on the table, in a sense. And often this is valuable to do because this actually drums home the message. It's often easy to kind of leave a trade, particularly a trade that's a winning trade, and think, well, that went well, good times, I'm happy, I've made some money. But if you look at it from the perspective of this is what you should have had and this is what you got, all of a sudden you've effectively been underpaid for doing a job. This would be like doing a piece of work for somebody, them saying we'll pay you this, and after you've completed the work, you say, do you know what, I'll only take half of that pay. You wouldn't do it. And that's the same with a trade. So go through and look at the performance of trades. And I've created this so we can send this over. It's a spreadsheet that allows you to track the performance of the trade over time. So just the win rate of the trade. What it also does is tracks the expected risk reward of a trade and then looks at the actual risk reward. And what you get at the bottom, what this all calculates, is your risk reward over time, or to a better point, the expected value of the trade, because this considers the win rate as well, because of the way it works it out. So let's go and have a little look at what you're trying to achieve here. What we've got in this example is you put in your expected, or what your target is. So let's say that's a 15 tick target. Your loss on the trade, 5 ticks. That's where you're going to place your stop. Now, yeah, this is hypothetical. So you're looking for a 15 tick winner, a 5 tick target. So your expected risk reward is 3 to 1, or 3. 21 to 5, then it's obviously 4.2, etc., 2.8, and then 4.4. So you've got an expected risk reward, you've got an average risk reward on the trade over time. Great, so you've got that much. What this bit is more importantly telling you and giving you the ability to do is compare your expectation of your risk reward to your actual and allow you to understand how good your performance was on that trade. So if we take this, what you're looking at then, you need the size that you've tried to get filled. So you've gone for 3, And the profit is in ticks, number of ticks. So that's 3 contracts times the number of ticks you've taken. So total number of ticks. So in this instance, 35. Now, you can do some simple maths. If you were aiming for a 15 tick winner and you got filled 3, this should have been 45. That would be what you get if you hit target. So what you've done is you've given yourself a lower risk reward on this trade. Now that seems pretty obvious. You can look at this then, and you have to then look at the trade in terms of, and this is where you can then use the statistics to go back to your results monitoring. Did the trade ever reach the target? Because if it didn't reach the target, this may well actually be quite an acceptable winner. But if it did reach the target, you've basically got paid significantly less than you could have. And that's what this percentage does. What the percentage does is it gives you the percentage of the profit, i.e. the percentage of what you should have got compared to what you achieved. So in this instance, you managed to achieve 78% of the objective profit. Not terrible. And dependent upon why you achieved that, that could be entirely acceptable. What it allows you to start to see then is, and it helps you in then defining why trades have gone wrong or why trades have gone right. Could you improve them in some way? Take, for example, the hypothetical 6 contracts here now. But you've made 74 ticks. 6 contracts for a 22 tick move should have yielded 132 ticks, but you've only made 74. So whilst the risk reward, 2.5 isn't that bad, it's significantly lower than the 4.4 you could have got, and really the big tell here, 56% win rate, or profit I should say, 56% of the profit. That is a massive reduction. You've been basically paid half what you should have been paid. In any other situation, you would feel absolutely robbed if you got paid half of what you should have been paid for something. But in this case, because that is the largest P&L trade of all of them, that would often look like a good trade. But in fact, I would argue that that is the worst trade of them all, assuming that they've all gone and hit target. But what this also does is this averages your actual risk reward over time. So it allows you to then see what the value of this trade is over time. And so if you consistently take this trade, you are actually getting a 7.5 risk reward. The reason being, on these 4, you've got a 75% win rate, and it's then averaging the risk reward that you actually get out of them. So that therefore gives you a 7.5 win rate. The total reward divided by the total risk. So the idea behind this is it allows you to then give a bit of structure to your trades, assess a trade comparatively to what it could have done, and then help you decide whether this was actually the right idea, or try and understand and pinpoint what it was that went wrong. You don't know from the numbers necessarily, but one thing you might be able to suggest is that when trading 6 lots, one of them is a loser, and when trading 6 lots, one of them has a very, very low profit. Is this in fact a case of upping size too quickly? That maybe you can't cope with that larger size, and that's partly why the performance is lower. So it gives you angles to go and explore your trades, and that's really what you need to do. With any trade, in order to evaluate and improve it, you need to go and ask yourself questions. And what is worth doing is then breaking those answers down into one of 2 things. Almost every mistake or every improvement can come from one of two things. Either it's a technical improvement that can be made, a better understanding of the mechanics of the trade, what happens when you're in the trade, the technical landscape, or it's a psychological one. Not holding a 6 lots to target, why is that? And so that's then part of the impact. One classic one that so many people fall into the trap of is taking a large loss because they move their stop. And again, this isn't a technical issue. This isn't a lack of technical understanding. The stop could be in the right place, but when it looks like it's going to hit it, people pull the stop. Because if you pull your stop, you've not lost. Doesn't mean you won't lose, but you've not currently. And what this usually then does is creates a bigger and bigger and bigger loss. So go through each stage of your trade. Look at your entries. Technically, could your entry have been better? Was there something you could have picked up from the order flow? Was there something else in the chart that might have helped you get a technically more precise entry, a better entry point? Psychologically, have you entered the trade too soon? Have you tried and preempted a trade? And so often I hear people say this, like, well, it was coming down to my entry, so I just paid up and bought it. And that's a panic sense. That's a fear that the move might happen without you. And I always hold the view that I would prefer to miss a trade than pay more for something than I want to pay for it. That's how you would treat most other purchases you go through. You will look at something and you say, yeah, I'd like that, But if the price is higher than what you're willing to pay, you don't buy it. Same with a trade. If you want to buy it at 50 and it's trading at 60, you don't pay 60 to make sure that you're in the trade. You wait and see if you can get 50. If you don't get 50, it's not the trade you want. So try and understand what's changing about the entry. Was the entry missed as well? Did you hesitate? Did you try and get too optimistic entry on a pullback, slightly too low? Again, explore what it was, what was the reason that the entry was missed. In some cases as well, and don't ever dismiss the fact that sometimes your entry is missed simply because it just didn't get there. Was your point of entry the right place? And if you can look at that and honestly say, yeah, I can't see how I could have had a better point of entry, then sometimes you have to accept markets don't go there. Often people try and engineer a trade to make it fit the idea. And in fact, sometimes if your idea is good and that's your solid logical entry point, and it doesn't fill you, well, quite simply, that's because it just didn't trade there. And that's the way things go. Don't re-engineer something to fit a situation that wouldn't actually make sense just to be able to say that's where you could have got in the trade. Of course, you could always have got in the trade if you paid up enough, but that doesn't make the trade a good idea. That's just a way of engineering an entry. Something that I think is well worth trying to explore with an entry is what made you confident of the trade. What was it that you saw that you felt, yes, now this trade is going to work? Because that then helps you either in adding on to a trade as the trade's going. It helps you in being able to increase size, because if you can define what it was that made you think, yeah, I have got this, I've nailed this now. If you can work that bit out, that's the point where in future, when you see that, now you can add size to a trade. That's one of the easier ways to add size to a trade. If you can work out what it was precisely as you executed that trade that really made you feel confident, made you feel that you were right. As long as, of course, your confidence was correctly placed. So you got to make sure that you're assessing those ones from the ones that actually worked. You were confident and it worked, because occasionally you can be very confident of something, it doesn't work. That doesn't mean you should put your confidence in that again in future. Stops. Classic psychological issue that people have. They either move their stop too close, tight stop because they don't want to lose money, or move their stop to trail faster than they really should, or they get rid of a stop, and you hear the common phrase, stops are for buses. Either of those is generally a psychological thing. That it is an attempt either to not lose a large amount of money, or what you perceive to be a large amount of money, or it's an attempt to just not lose at any cost, which is what happens when you when you widen it. And when you narrow it, it's a case of just don't let me lose. So you prefer to lose a small amount to make sure that you don't lose, which in fact, in many cases, you end up losing the small amount and you bleed by 1,000 cuts. Targets, similar things. What's happening when you hold the trade? How do you hold it to target? Do you? Because it's all well and good to work out the risk reward on a trade, to frame your risk on a trade. But if you don't adhere to that when you actually execute the trade, and consistently you never hold it to target, well, actually the risk reward that you think you're getting is far from that. And to a point, that can actually turn the trade into a negative expected value over time. So make sure you're always considering that. And if you're not holding it to target, this then allows you to ask, well, how do I? What is going on? Why don't I hold it to target? How could I hold it to target? A way that I've suggested to people in the past of holding trades to target is in fact, counterintuitively, to increase your size. If you are somebody who buys two, has a target up here, scales one out and then gives up there, well, you never get into target. You get an average price of here. So what I've told people to do in the past is say, right, well, actually, I'm gonna buy two and another one. So now you buy three. The market goes up, you can get one out there, great. You can get another one out there, great. But the last one, the additional one, has a stop, and it has a target, and it hits one or the other. You cannot exit anywhere else, and you have to coach yourself to do that. You have to say to yourself, right, I'm doing it with the first two because this allows me to bank some profit, because that's what you tend towards, and then one of them is going to target or is going to stop. This will also help you, because now you've got skin in the game, you'll start to see whether your targets and stops are actually viable, because when you get out too quick like this, you never actually really find out if that's a viable target anyway. If consistently this gets stops out, perhaps it's your target that's actually misplaced. So that way, you see from the own evidence that this trade works, that you are able to get it to target. And so in future then, make that 4, get out of one, run 2 to target. Make it 5, get out of one, run 3 to target. All of a sudden, these 1 and 1 become so irrelevant, you might as well hold them all to target. That's how you can then grow and learn and teach yourself, self-coach, to holding stuff to target. One other improvement, this is why you track the result, could your target be adjusted? Could your target be a bit further away? Does it need to be closer? That's very much a sort of technical skill set. The getting out early we just talked about, that in almost all situations is psychological, particularly if it is reaching target. That is just a desire to get yourself out of the trade. It could be technical, that you don't understand the nature of the move to target. And that's something as well that you need to, that then directs you to work on. So for every question, you then need an outcome. You can't just simply rest on the laurels of, are you getting out early? Yes, that's really a psychological issue. Okay, great, it is. So what are you going to do about it? How are you going to change it? That's the way that you have to approach it. That every question should lead to a new question of how are you going to deal with this? What are you going to put in place in future to deal with that? If you're getting out early because you just don't like holding on through slow moves, use something to help you. A moving average maybe. Use something else to help you. Put a stop and a target, an OCO order, and minimize your ladder. Watch similar trades over and over to visualize the nature of the movement. That way, you start to work out how you prevent yourself from getting out early, rather than just simply saying, I won't do that again. You can never change something you do by simply saying, I won't make that mistake again. Certainly not from something like this. If it's a physical thing, then maybe. Don't touch something hot. You touch it, you burn your finger, you say, I won't do that again. Even then, the temptation does get you, and you probably will still touch it again. And so just saying, I won't do that again, you're telling yourself lies. You will do it again unless you put something in place to prevent yourself from doing it. And then also, how do you feel when exiting? Are you relieved to be out of the trade? Are you pleased with the result of the trade? Often if you're exiting and you get this sense of relief, that can be a good thing if you have held the trade to target, because that says to you that you are pushing yourself. If you comfortably hold it to target and it makes no difference when you get out, that to me is suggesting actually you should be trading more size. There should be an element of tension, because that tells you you're trading sufficient size, you're pushing yourself enough. So you need that level of relief. If you're just getting out in the middle of nowhere and you're relieved, well, one, that might be a case that you are very uncomfortable with the trade that you're trading, perhaps you've increased size. So you have to bear it in mind of context. Are you increasing size? Is that what it is? It could also be a case that you didn't have a plan, and so you're just relieved to be out of the trade without it going completely wrong. So make sure you go through questions, question your trades. And this is not an exhaustive list of questions, but go through it and ask yourself these types of things. This way, you're always looking at little minor improvements, and minor improvements, marginal gains, are really valuable. The reason being that gains can be, or improvements can be achieved very quickly to start with, but always looking for marginal gains is what gets you to grow. This was a discussion that I had recently about edge gaps and what it is and what happens to new traders and then more seasoned traders. Why is it that performance doesn't go onwards and onwards and onwards in this continual linear growth phase? And the reason for this is what you call an edge gap. Now, when you're considering things from a technical or a psychological perspective, also something that is important, new traders, typically, it's going to be more a technical deficiency or a technical improvement that could be made than a psychological one. There's a lot more technical skill gaps that can be closed quicker for a new trader than they can for a senior trader. Once you've had 5 years experience, you've seen all sorts of technical patterns, all sorts of technical plays, all sorts of situations. So you're very, very good at recognizing them. Your pattern recognition is extremely good. So your technical skill gap is not very big at all. So it's hard to actually close that and get technically more proficient, because there are less ways that you can become more proficient. For a junior trader or new trader, you can fill these gaps quickly. And this creates performance, sort of the low-hanging fruit. This is why you can get very, very fast relative growth early on in career. Why somebody could very comfortably get 1,000% return on a $10,000 account, i.e. turn a $10,000 account into a $100,000 account. They can do that in a year. But you try and get 1,000% return annually, very quickly you're not going to do that. You're not going to 10x 100,000 account and then onto a million, and then again and again and again. If you do that 5 years in a row, you've now got $1 billion. And that's not realistic. And the reason that's not realistic is because of the fact that the extraordinary growth or exponential growth early on comes from closing all of those skill gaps. You close those gaps and suddenly you find there are many more new ways to make money. You get better execution, better trade and market selection. All of these things as technical skills that can be improved. And when I say technical, it's not just about understanding chart patterns. It is things like the technical aspect of what's the best market to choose in certain situations. How do you improve your execution? So the actual technical performance of a trade. How do you maximize trades? Can you actually increase size now in certain situations as well? That's where new traders get the huge amount of growth. For a more experienced trader, it's often a psychological improvement that can be made, because in many situations they have maximized an opportunity. As in, there are maybe only so many opportunities in a day, and an established trader is likely to be able to take almost all of them because they have the proficiency to do it. So if they can maximize as many opportunities as they possibly can, it's hard to suddenly make any more money, because you naturally would then need more opportunities to be able to do that. So often one of the things that is hampering growth, particularly once you get, and we discussed this myself and Alex, at what point is that? And we feel that this comes somewhere between the 100 to 200,000 pound mark, that the low hanging fruit is gone. Now it's a case of, can a trader actually grow again significantly, or are they someone who continually makes 100 to 200,000 pound on an annual basis? It's not to be shirked, but it's often you find people get to this point and they stagnate, and this becomes their earnings over time. Whereas for a junior trader, they may go from small earnings first year up to this level second, and then suddenly they're very flat. And that's because it's more of a psychological thing. Attitudes to risk. Are you willing to take that next level of risk? Because that next level of risk, the upping the size, because that's how you get the performance. The technical skill gaps are closed. The only way you get performance now is by increasing size. So if you can increase size, that's one way to do it. External influences as well. Often as your performance grows, your lifestyle changes, you now have more responsibilities and more costs. That has an impact, because that puts more importance on the necessity to earn, which inhibits your attitude to risk. If you know you need 100 grand, then it's harder to take risk that might mean that one year you might not make that, if you know that that's going to have a detrimental impact on you. Optimization of execution. What I mean by this is, are you optimizing every way that you execute? Can you improve this further and further and further? And often this is a psychological thing, that people feel that they've optimized their execution because the performance suggests that they have. But actually it's all of those marginal gains that you could achieve. You know, one of the traders is so hot on trying to get not the perfect execution, but never paying more than he needs to. And whilst this may sound very tight, you have to think about this in terms of the number of trades done over time. If you're giving away one tick on an entry, that doesn't seem like much. Oh, it's one tick. But if you do that on 10 contracts, that's $100. If you do that every day, that's $500 a week. If you do that every week of the year, that's $25,000 a year that you're giving away because you just don't really want to bother precisely getting that execution right. That's what I mean by optimizing execution. Ultimately, it's marginal forward momentum. And that's where the psychological side of it comes in. It's the attitude to the way you grow, to how you perform, to how you grow. So when you're thinking about the questions that I just proposed, typically you can get a technical improvement. Of course, most things can be improved in both sides, but the technical aspect is often more the impact than the psychological one. So let's turn this into an improvement then. You've considered some of these things. One of the ways I think you can always improve a trade is by not only just being able to draw out the objective of the trade, so this being a block reversal, so you're kind of drawing out your textbook, this is what should happen, but also going through and thinking about the thought mechanics within the trade. What should you be thinking as certain things happen, as well as observing them happen? So once you see a drop and you see a stagnating auction, this is an area where you can now start to think ahead about the possibility that this trade is on. Doesn't mean it is on, but it could be. So now you're ready for this. You then get a little clue. This is not an imperative, and this does not have to happen, but if you see it, all of a sudden now, that's really drawing your focus. So this should be a point where you're like, right, this is on. Focus up. This is now where we can be looking to get a trade on. I've got possibly an entry point coming up. And with the clue, if you get this, your entry could come in here. You may well be able to get in on a pullback before the move actually happens for the move through the range. So you can now start thinking about your execution tactics. The fast move. Once you get this liquidation move out, now you're thinking this trade is on. You're either in it already, you've got in it here. However you get into the trade, this is on now. And that should now be the moment where you feel confident, where you say to yourself, yes, I need to be in, or I am in. This trade is going to work for me now. I've got it. And then particularly once you come back, this is your final test. So when it comes back here, and this is the one, I think particularly with the thought mechanic side of things, this is where people go, oh, I'm not so sure, I don't like it, I'm not overly happy about it. This is the test. As long as it survives this test, the move is on. And once the move's on, and you break this high, your conviction should be there. But what you also need to think about is the execution tactics. This is a trade that typically is completed with a grinding move higher. That's a really hard move to get into. So what does that tell you? It tells you that your position needs to be on here. You're not adding after that. So whatever size you propose getting on this trade needs to be done in this zone here. Either here, here, or a cumulative of them. That's what you need to be thinking about. And so now you've got an improvement because you're refining down the execution of the trade. You're also giving yourself the ability to think this trade ahead. You see it coming. You know what could be happening now. You've seen the clue. Now you're really confident of the trade. You get the sign that it's going to go. The trade is on now. Now's the time to get in. That's the way you have to think about it. So it's not just about planning the picture of the trade. It's also about looking at this and saying, yeah, I've now got this, and this is the way you think it through. So final bit, we're going to go and have a look at translating this into other markets, and then also where you can use this in conjunction with other trades. So we've got the improvement, the thought process behind the trade. Next up, understanding where your trade becomes asymmetrical. We've talked about this already, but quite simply, you need to have planned this into your trade. That point where it becomes asymmetric is the point where you can maximize your positioning. And this is something that people are often unkeen to do, because let's say you're looking at this point here. Once you get the break, this is pretty much asymmetric. You're not going to end up losing on this trade, or you're highly unlikely to, and chance of it reaching the target of the high of the day, which is the objective of this trade, is now looking very likely. The payout's not huge, but that doesn't matter. This is the chance to add on to a trade, and a lot of traders will do it like this. You'll see that they end up with their biggest size for the last few ticks, and in fact, part of that, they may end up taking a portion of that trade for maybe 5 ticks, and that is it. But what you're doing is, once you can see that the trade is asymmetric, i.e. the odds are stacked very much in your favor, the chance of this going wrong is low, and you're in such a position that the chance of you losing is even lower, this is the point where you can then start to build that trade up. Back the trade to the end. And this way you're able to increase your size significantly. It may well be that you don't take loads out of it, but if you can add significantly more size for those last few ticks where you know that your chance of being wrong is almost negligible, that's how you maximize up a trade. That's where you get a huge amount of value in these types of trades. There's 2 areas here. I feel that the passive entry down here, you have essentially got an asymmetry. The payout is good. The chance of losing is low. Once you get to here, the payout is not so good, but the chance of losing is vanishingly small now. So there's this balance between the two. Take it back to expected value on trade. That's the way to think about that. So that's what you're looking for with the asymmetry. And with all trades, you want to try and establish where that point is going to be, because that's then the point that if you're looking to increase size, that's the point you can do it at. So that's asymmetry. Once you've got the clear template of how the trade looks, what it does, the thought process in it, you can now start thinking about, well, how do I improve this through my sizing of the trade? Next up, can you translate it? Does the principle of the trade work on multiple timeframes? Does that block have to be a certain amount of time? Can this be something that occurs very, very quickly? This is an example in the DAX, previous examples we used for the Bund. And this one, quick snap down, sideways range, inability to keep on going down. So this essentially, the principle here is this is an absorption move with a a very quick liquidation. The principle is very similar though. That what happens is after what looks like a very strong move down, the market stagnates quickly. And so if you go through the thought aspects of the trade, this is very similar. Move lower, it stagnates. It loses that look of being bearish because it doesn't form any kind of bearish continuation pattern, but instead forms a sideways block. You also have a failed attempt lower within this as well, and a building up of volume. So there are similarities in the way that you're thinking through the trade. Now, the move out is the liquidation. And because this has happened quickly, that liquidation is all the trade is. We get out, rush up, and that's the job done. But it's very swift. But the principle of it is absolutely there. So you can translate this across time frame. You can translate this across markets as well. Just because it works in one market doesn't mean that it won't work in another, because it's the principles you're translating. You're not translating the specifics of numbers of ticks. You're translating the principle of the trade. And final thing then, away from translations, this is looking at translation into another market. The principle still works, but you've then also got synergy. What synergy is all about is adding this strategy to structure. And this ultimately is where strategy becomes something valuable. That it is no longer just a specific setup, but this is something that you can expect within certain structures. This, for example, is a sideways block formed in the S&P during an overnight session. This is quite a common thing to look for. These little block reversals in the overnight session that come the main session, if you cannot find the drive towards the downside, this is where you get that same principle. The block breaks, we roll back to it at the beginning of the cash session, no continuation, particularly when you have this structure of downward move followed by downward move in the overnight. Now, you've got reason to believe a reversal anyway, and then you get this drop back to the block. All of a sudden, you now have an opportunity to buy. You have the break of the overnight. This is the bit where the move becomes asymmetric, and you can now play it to move all the way through the previous day's range. That's where your synergy comes in. This is where the value of this trade is more than just the trade itself. The value of the trade is it's a method to play this structural reversal. It's a method to reverse the overnight value being trapped down here. That's where the value really comes from with trades like this, or with all strategies. Being able to apply them to a wider structure, being able to apply the principle of the strategy to a situation. So what I'm not saying here is learn setup, setup, setup. You learn the strategy, you learn the method to take that trade on, because you can then apply that principle across multiple markets, multiple situations, multiple time frames. That's the value of a strategy. Next up, we're going to go and have a look at winners and losers. Before we do that, just a quick reminder about understanding where your edge is. And it's particularly pertinent with that block trade, because understanding where your edge is comes down to understanding what it is that is required to enter this trade. We talked about this concept that if you have simple criteria, your edge is in your execution, because that's the bit that everybody else is seeing. If you're seeing a really obvious trade, the way that you get edge is to beat other people within your execution skill. With this block trade, it's much more about where the access is, what you might call beyond the crowd. It's not such an obvious trade. We've made it seem obvious because you've broken this down, you've condensed the parts of the trade. And once you've done that, then you're seeing this beyond the crowd. It's not just simply an execution trade. And instead, you're now looking at it from the perspective of, this is a trade where you know what you're looking for. Your execution perhaps on that pullback is your opportunity to leverage the trade up, where many people would see this as a pullback that's just slowing down and a market stalling. You see this as an opportunity to leverage a trade up before we then break to the upside, where everyone then starts to chase the trade in as it becomes asymmetric. So think about where your edge is in each trade. Some trades, absolutely, the edge will be in the execution. Think of some sort of snap and run type strategy, which is kind of a last resort tactic. That kind of strategy is very much about your execution. Something like this, though, is very much more about being able to define the trade already, and your execution is your ability to maximize and leverage up where many people are going to feel that this doesn't offer a great deal. Because part of that is that knowing that it's going to grind higher means that adding into the trade later is hard, and that's what other people struggle with, which is why you then get this constant stuttered move towards the upside. So there we have it. Strategies, breaking them down, developing them into other markets and timeframes. Understand what your edge is on a strategy. Next up, we'll be covering how to turn losers into winners. So inverting an idea, and then we're also going to cover pattern matching as well. See you soon.